All right, so let's go ahead and finish up chapter 11. So, here, 11.5 and 11.6, we're going to be talking about the disposal of the fixed asset. Okay, what happens when you come across that point in time where you um, depreciate to the point where it's either reach the end of its life or you just want to dispose and just get rid of it off of your book. So this is how we dispose our fixed assets. So in this case, right, we have to understand what are the reasons for disposal. Okay, number one, it could be that um, you want to sell the asset. It could be that you want to get rid of it off your books, or if you want to exchange it for a newer machine, right? There's a trade-in policy for that, right? So there's many reasons why a business would want to get rid of their books off of their or get rid of their assets off their books, okay? Now again, how do we dispose a fixed asset? Well, we have to understand these these few features, right? The purpose of us even depreciating it is going to cause us to figure out what our book value is. And from there, that's going to give us an estimated amount to go ahead and sell our product, right? Or sell our asset, excuse me. So when we determine that, right, the book value means this is its holding value. This is what it's worth, right? That's why we spend depreciation to kind of figure out what is it worth now if I decide to go ahead and trade off, sell, or anything like that. What is my threshold that I could possibly get a gain for, or I could possibly get a loss for? So most cases when you actually sell your fixed assets and it's been used, you're more likely to occur a loss because again, especially to the person who you're selling these fixed assets to, right? They're going to devalue however they feel that it's going to be worth, and then you're going to set your price point, and they can haggle it. All right. So again, the chances of a gain is very low, but it's still a possibility, but the more you're more likely going to take a loss more than anything because a lot of people, right, especially when they use an asset, they're not going to take it for what your book value is worth, right? They're going to try to get it as cheap as possible because they don't know what's going on. They don't know that you used it to the ground. They only know that you used it, and that's already going to in their mindset drop the price down in half. Okay? So, how do we recognize a loss or a gain? Well, in this case, you gain if you sell it for cash or whatever form of kind of money, and the amount that you sell it for is above or more than your book value. Okay? Then you gain because you purchased your fixed asset originally and you sold it for more than what it's worth. Okay? And then a loss is going to be determined if you sell your fixed asset and it is below or less than your book value. Then you've taken a loss. Okay? So in this case, this is what you are going to be focusing on is you're going to be taking your depreciation tables out for in case you do get rid of your assets, what are the procedures and steps that you need to acknowledge to in order for you to get it rid of your books. So you do need a depreciation tables because that's going to tell you what your book value is currently after however many X amount of years that you've used your asset for, okay? So, what are the things that you necessarily need to have, and how do you dispose your assets? So, first off, you got to figure out what the purchase price of the fixed asset is. So, you have to go back and you have to determine what was the price that you originally purchased that at, right? We know this because in our books, we are obligated to record our fixed asset the day that we purchased it. We have it's valued at that price point. So that means that's my historical cost. So I know that and identify that, right? Second thing is you're going to be determining the amount of depreciation, okay? Because again, how do I get my fixed asset if I used it, right? What am I going to do to devalue the value of my actual fixed asset? I do that by depreciating it, right? I figure out how much it's going to cost me for every time I use my fixed asset. And then you're going to receive the payment, and then you're going to determine whether you received a gain or a loss based on the book value that you're comparing it to. Okay, so let's go ahead and do an example here. So if on January 5th you purchased a machine for $50,000, okay, on a credit card, so that doesn't really matter. Okay, assume that all fees and taxes are included. Okay, so let's go ahead and record the purchase of this fixed asset on the January 5th. So in this case, this is me buying my fixed asset. Okay, so this is where I said I bought an equipment, it was a machine, and I paid with my Visa credit card for the $50,000. So that means I'm gonna record that I got a machine in my fixed asset, in my ledger, that I got it for the $50,000, and then I need to determine if I decide to start using it, how much depreciation am I actually going to start doing. So in this case, I'm going to do it on a monthly basis here. Okay, and here's my variable saying, okay, well, I got the machine. It's right now worth $50,000, and this is what I made up, because in this case, right, we're a small business. We get to choose whether our asset holds a salvage value or not. So in this case, I said at the end of its life, it's got to at least be worth $50,000, at least worth of scrap metal. Okay, maybe it needs to be fixed up or something like that, fixtures. Okay, it's still going to be worth $5,000. Okay, and the estimated useful life of this machine is going to be 5 years, and the date that I placed into service was January 5th. So that means I'm going to start depreciating it January. Okay, so in this case, first month of depreciation, right? I'm going to do my method, right? In this case, I'm using straight line. So in this case, I'm going to determine this, that my basis is 45,000. My rate's going to be 20% because it's 1/5. And then because it's a month-to-month basis, I have to divide that by 12. So that's going to give me a total of $750 expense every single month. So in this case, I'm doing what we just learned, right? The whole entire depreciation section. So I'm keeping a track record of how my asset is going to be looking like at the end of every single month. Okay? So then let's see what happens here. So then we're using straight line to depreciate. So that means every single month I'm going to depreciate it by using depreciation expense with accumulated depreciation for that $750. Okay, so that's me upon using my fixed asset as of when I just got it, which is January 5th. So I started putting into service. So I'm starting to depreciate it at the end of January for the first month for $750. Okay. So then let's say 4 years later, okay, you decided to finally sell your machine, okay? It hasn't reached the end of its life yet, but you decided I'm going to get rid of it, okay? So then again, you wanted to sell it so you can purchase a new machine, okay? So then on January 28th, okay, January 28th, you decide to sell your machine for a total of $10,000 cash. So let's go ahead and record the sale of this fixed asset and determine whether you had a gain or loss. So in this case, right, we got to go through the steps again. How much did I purchase it for? Well, we purchased the machine for $50,000, but we need to also determine second thing, which is how much depreciation have I calculated so far. Since I'm selling it at the end of January, that means I incurred 1 more month's worth of depreciation expense because I'm doing it per month, right? But instead of selling it in the beginning of January, I sold it at the end of January. So I have to incur 1 extra month upon the 48 months because it was 12 months for 4 years, right? I used it for 4 years plus an additional month. So I need to calculate my final month's worth of depreciation. So in this case, I'm currently at this much right here. So I've racked up a total of $36,750 worth of accumulated depreciation. So that means my book value right now is at $13,250, right? So that's what I determined the value of my book of my asset at the end of the 49th month, okay? So then if I determine that my book value is 13,250, right? Then let's go ahead and proceed with my journal. So I know for a fact that I received a $10,000 worth of cash, okay, for my machine. I also have to recognize what was my historical cost. I originally purchased my asset at $50,000, right? Third thing I gotta recognize is how much accumulated depreciation did I collect on my machine. In this case, instead of crediting it because I'm writing it off, I'm zeroing out my accumulated depreciation. So therefore, I need to debit this account. If I debit this account for the total amount of accumulated depreciation, which was $36,750, right? Now I need to determine, did I take a loss or did I gain? And that's going to be whatever your credit is going to be. So in this case, right, if we know that my book holds a total value of $13,250, right, at the end of what I depreciated for, but I only received $10,000 cash, can you tell me, did I get a gain or did I get a loss?
Didn't you lose it?
You lost.
Because book value said that it's worth 13,250, but we only sold it for $10,000.
So in this
So
case,
there's a different. If our loss is $3,250.
good. So in this case, I have to determine that I got a loss because in this case, the difference, that's what I have to do. I have to figure out how much money did I lose out of this sale. In this case, we found out that 13,250, and then you minus this $10,000 cash you actually received for it, you lost 3,250. And guess what? My debits and my credits match here. And this is how I get rid of my asset off my books. I have to get rid of the actual asset itself, right, by crediting it because I'm getting rid of it off my books, right? I'm not buying it, so it's not increased with the debit. I'm decreasing it because I'm getting rid of it. But I also have to recognize that I used my machine. So therefore, I have to also write off my accumulated depreciation. And then so on and so forth, right? We recognize how much we got it sold for, and then we have to determine, did we get a gain or did we get a loss? So in this case, we had a loss for $3,250. Okay? Yes.
So, for example, only I can think is TV. So I had this giant TV for my business, and I need to get rid of it. But nowadays, they usually charge me to get rid of them.
Yes.
So for that extra cost that I have to pay out of my pocket to get rid of an asset, it won't be a part of what you just showed us. It will be a different thing.
You have the executive decision to make that. So do you want it to make it as part of the asset to get rid of it? You can. Or you could just say it was a separate cost or a separate expense to dispose my asset.
Oh, okay.
So
either way.
Either way. So if you want to
Okay.
include it into the asset or include it into this journal, you can. But if you don't want to and you don't want to associate it with the asset itself, you can create it as a separate because it was an operating expense, right? You need to consolidate your assets or get rid of them, right? So that could be an expense you had to incur for that particular time period that in order for you to get rid of your assets. So that could be a disposal of asset expense, okay, or cost to dispose by fixed asset, whatever you want to call it. Okay. So yes, in that particular scenario, then you would do so.
Okay. Thank you.
So especially electronics, right? If you're trying to get rid of it or pay somebody, you definitely have to pay that cost of disposing electronics. What's the word? Properly, right? You can't just throw electronic in the dumpster. No, you might have to pay for those big, huge dumpster bins, right? That you could just throw whatever you want in there, right? You still have to pay for that. So again, that could be an expense that you could incur, and you have the choice. Is that something that you're just trying to get rid of one asset for, or are you trying to get rid of multiple assets? If that is the case, then you're better off just writing it off as an operating expense. Okay? So good example. Thank you. All right. So let's go ahead and say a different scenario, okay? What if I decided that the same scenario happened? I purchased the asset for $50,000. However, this time, right? What if I actually sold it for $15,000 cash instead? How would I record this differently? Well, in this scenario, so ignore the first scenario, of course. The only difference here is, am I recording a gain or a loss? Well, first, again, we need to recognize, well, I just got $15,000 out of this asset, right? I still have to put the accumulated depreciation for $36,750. I still have to recognize that I sold my asset for, or in this case, I originally purchased my asset at $50,000. So did I gain or did I lose? Now again, we know for the fact that it's worth right now $13,250, right? Well, if you sold it for $15,000, what was your gain out of that? You gained $1,750. So therefore, boom, that's how you journalize it. Okay, it's on the credit side because what is it? You generated income. Okay, so that's why it's important that you understand it. And look, I even put gain on disposal of asset. So you guys get to make up what your accounts are going to be as long as they're reflective of what it is. And in this case, this is an income, right? You gain money, right? You earned money for disposing your assets. So this is going to be considered an other income. Okay? So any questions in regards to selling your assets? What is the process that you need to do? You need to write it off your books. So you need to have the two components of your depreciation and your actual fixed asset. All right. So then, if you decide, okay, that you don't want to sell your asset and you want to fix it, of course you can do that, right? A lot of times, I'll give you a great example, right? Oftentimes, or not oftentimes, some people, their hobby is they like to restore their cars, or they like to take an old car and spend some money to fix it up so it can start running and it becomes an actual functioning car, right? That hobby is very popular, and that's a great example of how restoring or improving or adding fixtures to it can either, one, improve the lifespan of the asset, or two, it will add value, right? If you originally bought that junk car for $5,000 and you throw $50,000 worth of fixtures, restorations, and all that stuff in there, you can easily sell that car for $60,000 and get a huge gain out of it. And that's what people do. So with that kind of, idea, of course, if you're going to add time, value, and stuff to a asset, of course, that means in your books, that's going to be one of those things that you have to modify and adjust. And that is perfectly legal because, of course, you can do that. Right? So again, here's an example, right? Fixtures. So if you decide to buy an asset and you want to, and it's right now it's maybe working a little bit, but you can obviously add fixtures, replace things, restore them, repaint the car. That's an example, or just replace that particular part and add value to your project. Then of course you can absolutely do that to any asset. But the only thing that is a lot of worries for many companies is the cost going to benefit me to improve or fix my fixed asset, is it going to benefit me if I spend all this money? Okay, so again, if your business is to produce, I don't know, produce a chair, okay, for instance, right? Would it be beneficial for you to just fix up the machine that you currently have? Would you spend like, for instance, like maybe $5,000 to replace one of the parts to create, so then I can extend the life of my machine, but also extend and also increase the value of my machine, right? Is that going to be worth it, all right, to do so I can produce more chairs? Well, if I have to spend $5,000 on a $50,000 machine, that's a lot of money. Would that be better to do, or would you rather invest that $5,000 into a new machine that you can pay off slowly over time? And if that's going to benefit you, and then of course with the new machine, maybe there's new improvements, newer technology, it could probably produce the chair a lot quicker. Then you have to weigh the options. Is it going to benefit me to spend all this money to fix the machine, or am I better off to just pay the price to just buy a new machine with better improvements, better technology, and better equipment? Okay, so that's an executive decision that you have to do. But if it's a minor fixture, then I say, why not just go ahead and fix it, right? So this is what happens if you choose to restore, fix, or improve your fixed assets. Okay, so again, here we go. Example here, if on January 5th you decided to purchase a machine for $50,000 on a credit card, all right, and assume that all fees and taxes are included, record that purchase of the fixed asset. So again, we've already seen this before, right? You're going to recognize that you bought it for $50,000 with a credit card, okay? So then let's say scenario one, okay? Example, what if 4 years later, right, you decide that you want to replace the engine motor, okay, to improve your machine, okay? And instead of buying a new one, all right? And of course, by doing that, right, so then on January 28th, so you installed the new motor, okay, which cost you $10,000, okay? Which extended the life of the machine, okay, by 3 years. And of course, it also increases the value of the machine itself, right? Because you spent $10,000 on it. So excuse me, if the current accumulated depreciation is currently right now $36,750, and the book value of the machine is currently $13,250, record the improvement. Okay, now I'm going to show you two methods that you can choose, right? You can only choose one, you can't choose the another. You can either choose to adjust the life, or you can choose to adjust the cost. Okay, so let's go ahead and take a look at what happens if I were to place this in here, right? And we adjust and increase the book value, okay? So this is the first one. So if I go ahead and use that $10,000 to increase my book value, how would I do it? In this case, you would decrease your accumulated depreciation by the $10,000, and you would add the cash, because again, you put $10,000 into your fixed asset. So instead of actually really truly adding it to your book value, I'm actually going to decrease it from my accumulated depreciation, which again adds value to your book value, right? Because book value is equal to the cost of the asset minus accumulated depreciation. So by reducing the accumulated depreciation, you're adding back value to your book value, okay? So once I've done that, right, how would it look on my depreciation table? Well, in this case, if right now my current accumulated depreciation is $36,750, right? If I were to decrease it by 10,000, right? What's going to happen? Well, I'm going to replace this number, and it's going to be for 26,750. So if I replace that, I have to readjust my book value, and now it's going to increase my book value by $10,000. So that's what you're essentially doing, is you're replacing the accumulated depreciation, so you're adding essentially the money to your book value. So that means when you continue on the next couple times, now this, again, it does extend the life of it, but that's not what you're focused on. You're focused on your book value dropping below salvage value now. Okay? Even though your asset increased by 3 more years, right? That's not what you're considering. You're considering that the book value has increased by 10,000, so you're going to need to focus on running your machine and focusing on calculating your book value so it doesn't fall below salvage value. Okay? So that's how you're going to do it if you choose to add the value to your book value. Okay? All right, so that means the next time you depreciate it, right? How are you going to depreciate it? You're going to be depreciating it by this 23, or you know what I mean, right? If you're using straight line, what you're going to do, it's going to stay the same. The only difference is that you're decreasing the book value much more slowly now. Okay, so that means, like I said, you're going to, for the next month, for the depreciation, you're still going to continue doing the same thing over and over. But this time, because you added that $10,000, you're just extending the life of it by slowly decreasing your book value slower now. Okay? So that's how you, that's choice number 1, right? Now, what if choice number 2 was, what if I decided to increase the asset cost, or in this case, right, extend the life of it to increase the asset, right? So if I'm going to increase the asset cost, how would I do that? Well, I can take my $10,000 and dump it into my asset, right? Okay, so this is choice number 2. Instead of writing it off the accumulated depreciation and changing the book value, I'm going to actually add $10,000 to my actual asset on the day that I started restoring it. Okay? So that means, how is this going to affect your depreciation? In this case, if I am right now currently at $36,750 worth of accumulated, right? That stays the same. Now, because I added this fixture and I added $10,000 to my asset, right? What's going to happen is that's going to change, and so is your estimated useful life. So therefore, I'm going to have to modify these two numbers, so then it's now $60,000, and my life has extended to 3 more years. So that means from here on now, I need to calculate it how I should be calculating it. But that doesn't mean everything in the past stays the same. You don't rewrite and do it all over again, okay? You start from the next month with the new information that you have and start depreciating on 4th, okay? So in this case, right, I have to figure out what the depreciation basis is. So 60,000 minus 5,000 gives you 55,000 depreciation basis. I do my rate, which is going to be now 1 over 8 years, okay? And then my depreciation expense is going to increase because of whatever value you're at. Or actually decrease. So in this case, boom, so if that means 50,000 on your 50th month, you're going to start at 55,000, and then you're going to rewrite, and then now your accumulated depreciation is now only 28,000 opposed to it was 36,000, right? So you're going to end up going back and adjusting all of this, but in this case, again, you're usually supposed to leave it at the way it is, but if you are one of those people who just want to redo it and start from all the way to from the beginning, then you can also do that too. So in this case, that's what we chose to do here is I want the actual accurate amount. I don't want to continue on. So in this case, we started from the 50th month because, again, you've already used it for X amount of years, right? You only extended its life. You didn't start from square one. So for the 50th month, this is how you depreciate it, and now the value of your book value, again, right, because the accumulated depreciation is now 28,000 opposed to 36. All right, so that's the other option that you can do to increase, in this case, you increase the asset, which caused you to increase your book value. Okay. Any questions there? So again, you are not going to be responsible for that because that's going to be the responsible of whoever is in charge of the fixed assets and purchases, right? So again, your only job is to record this. So that's why I'm showing you where these numbers come from. Yes.
Okay. Where I am confused is on the previous one, on the fifth month, we just add the value of extra repair we did to a book value.
The first one?
Yeah. But
No, we
then
added to the accumulated depreciation, which in other essence put the value in your book value.
also you actually took it out of accumulated depreciation because it went instead of increasing the accumulated depreciation, it went down on the 49th,
Yes.
which includes the book value.
Yes, because again, right, the book value is the asset cost when it's accumulated, right? So that's what you have to do is you have to revise the accumulated here, right? You revise as accumulated. It used to be 36 because you
Yeah.
put the $10,000 fixture in there. Therefore,
Okay.
if you take out from the accumulated depreciation, right, it's going to
Yeah.
reflect it into your book value. So you added $10,000 to your book value.
But in reality, we actually took it from accumulated depreciation. That's why the book value went up.
Correct.
Okay. But on the second one, you that's where I got resolved. I got confusing because you said we can go all the way back to the beginning of this machine's life to adjust it, or we can just do it on the fifth month when we actually had a repair.
That's up to your choice. That's why I said you have a choice between that two, right? Are you going to
Okay.
just continue from the 50th month and just continue going on forth? Or are you actually
Okay.
going to backtrack all the way from the beginning? Now, in this case, right, because of the beauty of Excel and we're using straight line, you could get that answer instantly,
Okay.
right? You don't have to actually go back and calculate one at a time. No, 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 no. The beauty of Excel is that you'll be able to produce the answer within 5 minutes. So that's exactly
Okay.
what we did. So instead of continuing on with the 50th month, we decided to go all the way back because in this case, right,
Yeah.
we have a new asset cost with a new estimated useful life. So in this case, we're not going to override it. We're just going to start from the beginning in this case. Okay, but you do have that choice.
Okay.
Right? But in this case, if you start all the way back from the very beginning, what you're going to see
Okay.
here is that now your asset is, or your accumulated now, instead of 36,000 and you continue on forth, you're now at 28,000 if you decided to adjust all the way from the beginning. So which one's ever going to benefit you better? Would you want to go back through all this? But again, it's not that much more work if you go back all the way in the past and rewrite your books, right? Because in
Okay.
this case, yes, you can do that because of the exception that you're adding a fixture to this.
Okay.
Okay, but
But
then
if
again, see, but
mhm.
it's the difference here now is instead of 36 that you're starting off with, you're at 28.
Okay.
Mm-hmm.
Okay.
This would definitely benefit you way more than starting off in 36.
Yes. I think so.
Yes.
I will look through
Yes.
again, comparing the two slides, and then I would know. Okay.
Mm-hmm.
But you're saying a number of the book value is different between the two methods.
Yes,
You know.
because
Okay.
okay, so one of them you're just changing the accumulated depreciation. So you're just adding the value to the book value and you're going to continue on using the same number, the same 50,000 because you didn't add value to the asset cost. You just only taken out the money from the accumulated depreciation. You just changed the book value. So in this case,
Okay.
you're still going to be doing the 50,000 depreciation basis. You're still doing the 1/5 estimated useful life even though you know that you extended it for 3 years. You're still
Yeah.
going to be doing that because at the end of the day, you're just slowly depreciating it off your books. Okay?
Okay.
Where this one, you
Uh-huh.
change the value of your asset. You change the estimated useful life. So in this case, because you change that now, your
Yeah.
depreciation method, the way that you've been calculating everything, all the numbers are going to be different.
Okay.
So that's the
I
difference
see.
there. One of them, you're adding value to the book value. This one, you're actually changing the value of the asset cost, which causes you to have to redo the entire depreciation method to get you your book value to be what it is now.
So we are alluded to change it when we make the improvement to our
Yes.
assets.
And
Okay.
you have the choice. So that's two choices, right? Honestly,
Yeah.
I think the easiest one is just go do the first one. Just change the
Yes.
value of the accumulated, because that's going to be the most easiest one, because all you do is just continue going with what you were doing originally, instead of
Yeah.
having to backtrack from the beginning and start all over to get you your new accumulated depreciation to be 20 was it 28,000. At that point,
Yeah.
you're at 28,000, where the other one was 26,000, right?
Yes.
So in the other one, it would be definitely much more easier to do. But again,
Yeah.
that's why I tell you have choices. You can make whichever decision works best for your company.
Okay. Thank you very much.
So let's see here. Exchanging your fixed assets. Yes, there is a policy where you can trade in your assets, and you basically either get a new improvement, or you just trade in your assets for another asset, right? That is possible, right? So a great example is going to be a car trade-in, right? Oftentimes, a lot of businesses, they look into wanting to do this kind of type of system where, instead of disposing your fixed asset, why don't you trade it? Okay, so this is where we're going to take a look, where maybe we have a company car and we want to trade it in for another car. Okay, so again, a lot of other companies, they do that too, right? Where, hey, or you can even call those businesses and say, do you guys have a buyout or trade in value option? And if they do, they do. And usually those kind of companies will work with companies like you, because if you're in the business of whatever you're doing, right, whether it's retail, they're more likely to do the buyout or the trade out value for you, instead of, getting rid of your asset and buying an asset without going through the trade in value. Okay. So for this example, right, we're looking on January 10 that you decided to purchase a small sedan for $35,000 on a car loan, okay, with a down payment of $2,000. Okay, assume that all fees and taxes are included. So again, let's go ahead and record the purchase of this fixed asset. So we decided to buy a vehicle, all right, and we took a loan out of it. Okay, so usually this is a typical thing that you'll see, is this is what I talk about, what I mean buyout option, because what happens here is, if you're going to trade your car in and you still owe money on it, the bank is going to buy you out of your loan and basically force you into a new loan. So that's why it's called buyout or trade out option. Okay, so in this case, we took a loan out, and it's valued at $33,000. Okay. So here we're gonna depreciate it, because we're obviously gonna use our car. So we have it for the sedan for $35,000, and of course we know for a fact that our sedan's gonna at least have a salvage value of $5,000, right? And we placed it into service on January 10, and it has to us its estimated useful life of 10 years, right? This car will definitely last you 10 years. Okay? So there you go. We depreciate it for the first year. So we know that this is what it's going to look like. Okay, so we're now down to $32,000. Okay, that's our book value. Now, here's one thing that you need to know, especially when you're doing a buyout trade out option, is whatever book value that you have it recorded on your books, that's not going to take into any consideration, because in these kind of things, they have a professional person who appraises those kind of fixed assets, so they can give you a fair market value. Okay, they'll tell you, right, they'll look in the Boo Kelly book and say, your car, because you use this many miles and it's this model, it's this year, we appraised it for X amount of dollars. So that's exactly what's going to happen if you choose to, in this example, have the buyout trade out option. So in this case, on this example here, on December 28th, the car dealership offered you to trade in your sedan for a used truck, okay, which has a fair market value of $30,000. usually they try to sell you something that's either in the same price range, or maybe like a 2000 for 3000 $5000 a little over. Okay, so they'll try to trade you out with the best amount of money that you can get for whatever car that you're trading out for. So in this case, right, it has a fair market value of $30,000. And then, of course, you go to the dealership to get an estimate of a fair market value for your sedan, which was quoted at $30,000. So you got a $30,000 value out of it, even though you know that it on your books it's worth 32,000. But again, because of you know you have to go through an appraisal, right? They tell you, you know what, it's worth $30,000, so you can do a swap out, trade out deal to get a used truck for the same exact value. So record this impaired loss and trade in for the vehicle. So, how would you do that? First, you have to recognize the accumulated depreciation that you accumulated on your car. So in this case, right, we devalued our car for $3,000. Okay? You're also going to get rid of your asset, your car, for $35,000. Okay, which is what you originally purchased it at, right? Your historical cost. You're going to gain a truck that's worth $30,000. Okay? And of course, you're also going to take a loss on the swap out deal, because in this case, your book said it's worth $32,000, but it got appraised and valued at a fair market value of $30,000. So in this case, you do have to go ahead and swap that out. So instead of getting cash for your fixed asset, you're just trading it in for a newer asset. Okay, so of course the truck is also going to come with all the information of how much it's been depreciated, XYZ, right? So that when you do trade out your car, right, you could start off depreciating it however you want to. Okay, so again, this is the trade out buyout option exchange policy, right? Any questions here? Okay, so last thing that you can do to your fixed asset is you could just abandon it. Okay, if for any reason that you have a fixed asset and you know you're not going to be able to sell it for anything, not even for scrap metal, you can just simply abandon it, or in this case, just dispose it into the nearest local trash can. Okay, because in this case, you already assumed that, well, my laptop that's 7 years old and it's worth $87, no one's going to buy that. No one's going to buy a 7-year-old laptop off of your hands. So in this case, you're better off to just simply abandon it and dispose it. So how do you actually get this off your books? In this case, right, let's do another example. On December 31st, you drove your truck to the end of its useful life, okay, of 10 years, and it has a salvage value remaining of $2,000, okay? And of course, you originally traded in your sedan for the truck valued at $30,000. All right, and of course, you decided to abandon it at a tow truck junkyard. Okay, so in this case, how do I write this truck off my books? Well, let's see. First off, we acknowledge that you depreciated to the point where it's the end of its life. It's worth $2,000 left, right? You originally traded it in for the value of $30,000, right? This has nothing to do with the loan, because you probably paid off the loan at that point, right? Because you had it for 10 years. How much did you depreciate it for? Well, if I had a salvage value of $2,000, that means I have to run it all the way to the end of its useful life to get me a total of $28,000 worth of accumulated depreciation. And that's all you have to do. Get rid of it. And you're going to take a loss on the disposal of asset. That's it. Right? You just get it rid of your books, and you just have to accept that you took a loss. Right? So any questions here on just throwing your asset away? Yes.
I'm trying to see. I'm trying to see why that $2,000 is considered a loss. Oh, it's salvage value.
Yeah, it's because
Really?
because you said to yourself that this truck, even after past its 10 years, it should hold a value of $2,000. But
Okay.
but no one's gonna buy it because it's so old. It's been 10 years. There's probably lots of wear and tear. So you decided, you know what? I'm not gonna try to sell it. I'm not gonna waste my time to put it on the market for something that no one's gonna buy. So instead, I decided to abandon it to a tow truck yard that isn't going to give me any cash value for it. They just said this is only a tow truck yard that you can abandon your car. So that's exactly what you did.
Okay.
Yes, there will be fees and things that you have to do because you can't just go to a parking lot and just leave your car there. Obviously, you have to go through your DMV to write it off the books and everything. That's going to cost you money. But what I'm trying to say, essentially, how do you just get rid of the asset? You just throw it away and write it off your books, and that's it. Right? Because it had a value of $2,000, but you weren't even able to sell it to get any money out of it. So you just
Okay.
abandoned it.
I see. Thank you.
Okay, so that whole section was how do you get rid of your fixed assets that are currently on your books. Okay, so last section I'm going to show you real quick is going to be what happens when you're trying to get rid of your business. Okay. So this is where goodwill comes into play, and this is where impairment comes into play as well. So this isn't us getting rid of our business. This is us acquiring a business that already exists with things that are already existing, okay? But it also applies in a similar sense where if you're trying to abandon all the fixed assets that are in your store and try to get rid of your store, then this also falls in the same line, okay? So what is goodwill? Goodwill is what happens when you decide to acquire a business, okay? Now, oftentimes you'll see that a lot of small mom and pop shops, they tend to go out of business because, maybe they weren't making enough money. They kept taking loss after loss after loss. There's no customers coming in. So they decide to abandon their business and start new, or a company decides to go and acquire that company and do a hostile takeover, okay? Those are options that are completely valid because, again, we live in a society where we're consumer based, right? We need businesses to run our society. So without businesses, and a lot of oftentimes what you normally see is you see businesses partnering up with other businesses, right? This is also that kind of entity where you have an umbrella business that likes to acquire many smaller businesses to basically keep them up and running, and so on and so forth. So for any reason that you do end up having a hostile acquisition, right? This is usually what happens when you do, and goodwill is a possibility that can arrive from those hostile takeovers, okay? So for instance, right, this example here is where a company, ABC, wants to purchase company XYZ. So in this case, what we have to do is when a company decides to acquire another company, right, that is already existing, but they're being short sold because they no longer can do business. So in this case, what is going to be looked at when we take into consideration of what this business is worth? So what happens is we're going to be looking at what the business has recorded on their end, right? So in this case, they said they have money, they have accounts receivable still being collected, they have inventory, and they have fixed assets, okay? And of course, they have a loan, and of course, they have equity worth $82,000. So in this case, their assets is going to be a total of $132,000, okay? So that's what we're looking for is what is the total amount of assets that this business has on their books. And what's going to happen is once you got in their books, then it's going to be subject to appraisal one more time because that's how it is. We're going to take into consideration, right? If I were to acquire this business and I were to sell off these assets or sell off these accounts receivable, what would I get my fair market values worth? So in this case, right, cash is cash, so you can't change value of cash. So in this case, you're still going to get 25,000. However, for the accounts receivable, you can sell for 36,000, right? Or sell it to somebody for 36,000. Inventory, you might get out money from inventory. You can get $40,000 worth of inventory. And for fixed assets, again, you can sell them, short sell them, and still get $100,000 worth out of it. And then you find out that they had a patent which was worth $10,000. So in this case, right, and we also need to subtract the loan because we're looking at the net value of it. So in this case, we also have to make sure that we need to pay that loan off. So at the end of the day, you end up getting a fair market value, okay? So then you went, again, fair market value comes from after getting it appraised, okay? They're taking into consideration what the true value is, even though we recorded it in our, or XYZ company recorded on their books that this is what it's worth. This is us taking into consideration, what if I resell these items? What are my actual true value, my fair market value, if I were to acquire XYZ company? So in this case, I have a total of $1,600,000 net asset worth, right? Because of course you have to consider the loan that you have to pay. Okay. So once you've done that, then you say, yes, let's go ahead and acquire this business. So then on June 30th, company ABC purchases the company XYZ for $200,000. They purchased it for more than what its fair market value is. So again, that's the key word here, saying, wow, even if so my book value, right, is definitely significantly lower than my fair market value. So in this case, I'm going to invest money into this company because we could probably turn this company around over and be able to make it into a successful business. So in this case, I decided to purchase it for $200,000, a couple hundred, in this case, a couple $1,000 more than what its fair market value is. So in this case, since I'm purchasing it for $200,000, how does it go about? Well, you are acquiring the business, so that means you're acquiring its assets, it's whatever that it's assumed that is there, right? So you're going to acquire the loan as well, and you're going to acquire the asset, the accounts receivable, the inventory, fixed asset, and the patent, okay? So we already know that this is all worth, because when we went through the appraisal, this is what its fair market value, this is what it's worth on the market. And of course, you decided to say, hey, I'm going to go ahead and purchase it for $200,000 cash, right? So then what happens here? Since you're buying the business in the business name, you generate what's called goodwill, okay? And that goodwill is going to be the difference between the fair market value and the price that you paid for it. Because again, you added extra value to a company that was worth only $161,000, right? So in this case, you gained $39,000 worth of goodwill. Okay, this is considered an intangible asset, right? Because you can't touch goodwill. Where did your goodwill come from? It's because you invested your own money to acquire a business. So you are generating an invisible brand, we would call it, right? An invisible thing around a business that you're acquiring. So that's where goodwill comes from, is that when you end up buying more than it and you decide that you want to invest in reviving this company, it's now has an additional goodwill worth $39,000. Okay? All right? And impairment. So, of course, because you generated goodwill, you have to test to see if it can become impaired at any given moment in time. Because the idea of a goodwill doesn't actually have an idea, it doesn't cease to exist because it's intangible, right? We have to continue to test it year after year after year because of the idea that you purchase a business and you're investing into an idea of, or the business name itself, or the business company idea, but it's not tangible. So it can fall and it can break, it could, it can crumble invisibly, right? And we call that impairment, okay? So in this case, right, what is it that we have to do to test goodwill to see if it's impaired or not? Now, in this case, we're going to be constantly calculating the fair market value of everything, or in this case, book value, to the fair market value constantly over and over and over for every year. So in this case, every year, okay, because it's at risk to change its value tremendously. Okay, so realistically, goodwill will eventually no longer hold its value, right? Because of it's not tangible. Okay, so how do we go ahead and test for impairment? So step one is we're going to identify identify and compare the book. So in this case, example here, company ABC purchased company XYZ for $200,000 cash, which gave us a total of goodwill to be $30,000. And if a year from now the fair market value of the net assets for the company XYZ is now valued at $175,000, right? Now you need to test the goodwill for impairment. So in this case, right, we need to go over the books one more time. In this case, right, we originally had a fair market value of now, right, a year later, it's now worth $175,000, right? You're going to less the carrying value of goodwill, which is what you originally had it from the previous year. So again, the previous year, you had it for $161,000, right? And you're going to determine the difference between them, which in this case is going to give you a $14,000 difference. So in this case, it's going to be impaired by $14,000 because it increased its value. So therefore, you lost money because you purchased it for $200,000. So in this case, you lost the impairment by $14,000. So once you have figured that out, right, we're going to compare, right, if the goodwill was at $39,000 and if you take the difference again to recalculate what it was, right, you're going to get less the implied goodwill, which is that $14,000 difference, right, and you're going to get a loss of impairment for $25,000 because again, you originally quoted it for $39,000 because it lost value due to because it increased in its fixed assets. You have to include that $14,000 impairment, which is going to be, it says less, but in this case because it was negative, because you lost that money, it's going to impact it by increasing the loss of impairment to $25,000. So in this case, it went from $39,000 minus the $14,000 will give you a total impairment of $25,000. So that means you need to revalue your goodwill because you lost value over it. You paid originally $200,000 when it was $161,000. Now that it increased to $175,000, you took a loss basically. Okay. All right, and that's goodwill. All right, goodwill is not really important unless you plan to acquire another business, but these are the steps, and I actually wanted to make sure you guys knew this because goodwill will appear if you choose to go on and go forth in accounting, but also we're also going to acquire a business that we have in Coffee Cafe. So I kind of want to make sure you guys understand where did this goodwill come from, okay? And in this case, this is extra information, but this does happen in real life, okay? Because in the reality, right, there are too many small businesses that are not surviving and they need other companies to purchase them and, to help them operate their normal business because they can't survive on their own, okay? All right, so for this one, no questions unless you need some clarification, okay?